Hello, everyone, and welcome back to Sudden Wealth. I do hope you're having a wonderful day and that you have some very nice plans for the weekend. If you do enjoy the content, please consider dropping that like and subscribe. It greatly helps the channel. So, thank you very much. Now, I've created a new series not so long ago about the basics of bonds, stocks, commodities, and crypto. And last time we spoke about bonds, and as I mentioned, bonds, they trade inversely to their yields, which means if yields go up, if the central banks keep raising rates, the value of the bonds goes down, but you get a higher coupon, meaning a higher payment or interest payment in your bond if you buy new ones. The reason is very simple. If you're holding to a bond that yields 3% over 10 years, and the rates go to 5%, and now you can get a new bond for 5%, the only way you can sell your 3% bond is if you sell it at a big discount. That's it. Why do people buy bonds? Typically, when there is a market crash, bonds go up. It's perceived as a safe haven. If it is a safe haven or not, that's up for argument. But the point is, if sufficient people believe it's a safe haven, then it becomes a safe haven. Simple as that. And also, when you're getting to your older days, your old age, you know that stocks can crash 80%, 85%, although not very common, it can happen. So in 2000, the NASDAQ went down 83%, and it took about 15 years to go back to the same level. Now, if you're a person in your 70s, can you really wait until you're 85 to be in the same place? Probably not. So what do people do? They shift to bonds. Why? Because they give you a predictable amount of income. If you buy government bonds, theoretically is the least risky place to be. And basically, let's say if you have a lot of money, let's say you have $10 million, if you have something yielding, I'm just going to give us a weird example, 10% per year, right? You get $1 million every single year by doing nothing. And basically, if you will, the closest to guaranteed as possible. So it makes perfect sense. And you have certain bonds which are tax exempt in certain jurisdictions. This goes into technicalities on taxes and on legality. So I'm not going to venture into that. You have other countries with no taxes whatsoever. It depends on where you live, depends on your situation, but there are certain instruments that make sense. Now, stocks and commodities. So let's start with commodities because it's the easiest. Commodities is a very strange beast. Why? Number one, you have typically, if you're going to go for oil, coal, corn, natural gas, this kind of stuff, they typically trade under futures contracts, which are derivatives contracts, and they have embedded leverage, which means it's usually very risky. Now, if you go for ETFs that just group up commodities, typically the expense ratios, so the money you spend by having that investment, is quite higher than, let's say, a stock ETF. It's more volatile, and you can really get nowhere if you're not careful. So the way that commodities trade, they trade in like this weird 30-year cycle in which you have a bear cycle, which is very negative, like things go down 80%. Then you have the bull cycle, which is, and by the way, that bear cycle tends to last about 2 years. Then the bull cycle, which basically commodities can go up fivefold, sevenfold, eightfold, also lasts about 2 to 3 years. So that's 5 years. The other 25 years is basically sideways, like this, up and down, but within a range. It's extremely boring. And I will give you this example, which is in 2007, I believe, oil hit $150. Not even with huge inflation, not even with the war, the maximum we saw was 130. So people who bought oil 150, 2007, they are wrecked, even now. after so long. But that's the point. If you bought gold in 2011, gold went to 1900 something, and it's now 1905. Like last week was in the 1800s. So you would actually be down versus 2011. That's my point. And gold is a bit of a special commodity because it also has monetary value besides the industrial side. So I would say commodities are terrible investments in general. I mean, you really need to be a specialist in the space. You really need to understand what you're buying, when you're buying, and what type of commodities you're buying. But for some reason, people have these weird fetishes and they love them and they go all in on them, like people who went all in silver 2011. I mean, people just have this crazy fixation with it. Now, in theory, in inflationary periods, commodities do very well. Why? Not because commodities are gaining value, but because the currency in itself is losing value. So you need more paper to buy the same commodity. But you're going for a niche of a couple of years, and it goes from bullish to bearish extremely quickly. So if you miss the boat by a little bit, you get completely annihilated, and then you have higher expenses on the ETFs you need to hold. To me, this is my personal opinion. This is what I do. Okay, you do whatever. If you want to go all in commodities, you do you, right? But either you are a really specialist in the area, you don't do anything else. Either you're very confident in your abilities to pick the right indices or even stock related companies, or you'll probably get completely destroyed. And these things move extremely quickly. So if you miss the boat, you can be stuck on it for 30 years like an idiot, or just take the loss. So I stay away from it myself, but I just wanted to put it out there. Most people are not even aware of these 30-year cycles. So yeah, I hope this is clear. I mean, if you feel confident, if you feel you're a specialist in it, good luck. If not, at least you know the background behind those investments. So thank you very much, guys, and I'll catch you in the next one. Next video on this series will probably come tomorrow. It's going to be on stocks, and then the other one's going to be on crypto. So the real basics of investing in all of this. So thank you very much, guys, and I'll catch you in the next one.